On June 26, 2026, the Nikkei 225 suffered one of its worst days on record. The index fell 3,005 yen, a drop of 4.15%, and closed at 69,360 yen, the third largest point decline in its history. This was a classic risk-off session, driven by heavy selling in AI semiconductor names. The clearest sign of the mood was the single most actively traded security of the day, a Nikkei Bear 2x ETF, a product that profits when the index falls. Money poured into downside hedges. And yet, in the middle of this market-wide sell-off, a specific group of stocks stayed resilient, and some even rose. They were not chipmakers or AI plays. They were event-driven stocks, names that move on something happening to that one company. Today we will decode them through 4 patterns: a takeover bid, a management buyout, and upward earnings revisions. None of this is a recommendation to buy or sell any security. Why can these stocks decouple from the broad market? There are 2 structural mechanisms. The first is the price floor created by a takeover, a TOB, or an MBO. In these deals, a fixed purchase price is announced up front: we will buy your shares at this price. The share price is then pulled toward that level, and the announced price acts as a mechanical floor. Because a buyer has committed to pay a fixed amount, the stock resists falling below it even when the whole market is crashing. The second mechanism is fundamental repricing from an upward earnings revision or a special gain. These are not rumors, they are verified numbers, so the stock is actively bought and actually rises, even on a dark day. So we will look at this in 2 layers: names that simply hold their value in a crash, and names that stage a genuine counter-trend rally. Pattern 1 is a TOB bidding war, Makino Milling machine, a major machine toolmaker. This stock sits at the center of an escalating contest over its acquisition price. It began when the company received an unsolicited approach, and friendly bidders stepped in. At one point a deal was agreed with MBK Partners, at 11,751 yen per share. But on April 22, 2026, the government issued a cease and desist recommendation against that deal, the first ever under Japan's revised Foreign Exchange and Foreign Trade Act, citing the risk that Makino's machine tools could be diverted to military use. With the plan back to square one, the fund NSSK came in with a far higher counterproposal of around 16,000 yen. That higher competing bid, arriving on top of state intervention over national security, established a robust new price floor. The stock held in the 15,000 yen range even as the market fell more than 4% on the 26th. Pattern 2 is a high-premium tender offer, Twinbird, a home appliance maker from the Tsubamesanjo region. The acquirer is Japanet Holdings, the mail-order giant, at a purchase price of 800 yen, roughly double the previous day's close of 395 yen. The logic is vertical integration, combining Japanet's selling power with Twinbird's manufacturing. But there is one important caveat. Twinbird's board has not yet expressed approval of this offer, so completion is unconfirmed. Without the company's consent, the bid could still be withdrawn. The extreme premium acts as a magnet for the share price, but the deal completion risk keeps it trading slightly below the 800 yen target rather than right at it. Pattern 3 is an MBO, a management buyout taking the company private. Satsudora Holdings is a drugstore chain based in Hokkaido. The acquirer is Terra, a vehicle set up under Mitsubishi-affiliated Marunouchi Capital, with a purchase price of 1220 yen. The share price is strictly anchored to that 1,220 yen figure, and it held firm on the crash day. That is the price floor at work. But going private carries a cost for shareholders. The dividend has been revised to 0, and the shareholder perks have been abolished. Short-term holders lose the income and the perks, while their shares are simply bought out at 1220 yen. Now we move to the names that actually rose on fundamentals, the genuine counter-trend rallies. First, an upward revision at Ceres. The company announced it would sell its entire stake in the crypto exchange Bitbank to the SBI Group. That sale generates an extraordinary profit of about 5.5 billion yen, lifting Ceres' full-year net income forecast from 1.6 billion yen to 5.9 billion yen, roughly 3.5 times higher, and its best profit in 5 years. On top of that, it boosted shareholder returns, raising the dividend by 90 yen and announcing a share buyback of up to 2.5 billion yen. That influx of verified cash and the immediate return to shareholders overrode the gloomy macro mood, and the stock jumped 20% on the 26th. From the same upward revision group, one more name, Miyakoshi Holdings. Its core business is a very large mixed-use development, the WIC project in Shenzhen, China. On the morning of June 26, the company revised its recurring profit forecast for the fiscal year ending March 2027, flipping from a 360 million yen loss to a 480 million yen profit, a clean swing into the black. The market welcomed that decisive turnaround, and the stock rose 13.6% against the crash. Once again, it was not speculation but the steady progress of the project and the hard numbers behind it that drew the buying. But not every counter-trend rally is healthy. As a cautionary case, consider G-Next. Its shares jumped about 17.4% on the 26th, but there was no clear corporate disclosure behind it, just associative buying tied to the broad data center theme, in other words, pure speculation. With a small float, the stock moves violently, and this is the behavior of short-term money manufacturing a price. There is no price floor like a TOB, and no numerical backing like an upward revision. A price built on supply and demand alone can fall just as fast as it rose once that money exits. It is a fundamentally different animal from Ceres or Miyakoshi, and telling them apart matters. This is an AI-generated caution. To synthesize, what we have looked at today is investing that reads a company-specific event rather than the wave of the whole market. But this approach always comes bundled with its own specific risks. 1. The risk that a TOB or MBO does not complete, especially a deal like Twinbird's, where the target has not endorsed it. 2. Once the price has converged to the buyout level, those prices act as hard ceilings, so the upside is strictly capped. 3. Extraordinary profits are one-off, a one-time asset sale gain like Ceres will not repeat next year. 4. Regulatory risk, state intervention, like the Foreign Exchange Act order in Makino's case, can abruptly halt an agreed deal. And 5. The crash risk of purely speculative, manipulated names. If you break down the reason behind each dramatic move, one by one, you can avoid being tossed around by crash headlines. This video contains AI-generated and AI-edited analysis, and forward-looking views include AI estimates. It is not a recommendation to buy or sell any specific security. Please make your own investment decisions.